We will expect a moderation in the growth. We basically, as we called out, our business growth momentum will continue. We're confident of that momentum continuing in Q3 as well. It just would get a little bit moderated because of furloughs and fewer billing days.
But apart from furloughs and fewer billing days, are there any other sectors, geographies, where there are some warning signs, some weakness?
No. We're actually seeing the momentum continuing in Q3 as well.
Okay, fair enough. The annual wage hike gets rolled out in Q3 and Q4, and you have quantified that it will impact your margins by 200 basis points. So what are the exit margins looking like for LTIMindtree?
So we don't give the guidance on margin, but typically you would see that in the quarter that we roll out the wage hikes, the full impact will come in that quarter. It will get offsetted with continued operational efficiencies and the initiatives that we continue to run. So there will be some recovery of that margin in quarter, and the subsequent quarter we will be able to recover a higher portion of that. It's the usual cycle that continues. So we don't guide for margin, but you'll see the wage impact will be probably the highest in Q3, and its impact will reduce in Q4 as we are able to recover a little bit more.
Healthcare and BFS delivered very strong growth for you. Healthcare at 5.9%, BFS at 4%. Will the momentum continue? Are we likely to see a sustainability of these kind of growth rates?
On BFS, we are confident because our growth in BFS was very broad-based. It did not come from few accounts, but it come, top 10 or 15 of our BFS accounts shown good signs of growth, and hence we're confident that momentum will continue in the Q3 as well. On the healthcare side, if you see our numbers, it includes healthcare, life sciences, and public services. So we had a little bit more growth on the public services side, but which was also very deal specific. So it isn't broad based. So we wouldn't look at the similar growth rates in Q3 for that portfolio.
You've also called out softness in a few travel and tech clients, particularly clients who are dependent on Boeing for delivery, where you are seeing softness. How much did that hurt your revenues in Q2, and how long will this weakness last?
So within our consumer portfolio, it is sort of the broad industries as part of that. Within that, the travel and travel tech companies, especially customers in the US, they continue to have a significant challenges in keeping up with their revenue profile because the deliveries are delayed for them. And we expect that softness to continue for a few more quarters till they see the upside. But our hospitality portfolio has grown very well. And within that portfolio, we also have real estate services. Now that, given the mortgage rate related issues, they continue to see some softness with rate reductions happening in the US. Hopefully that sector will start to see some turnaround in the subsequent quarters.
What's the contribution purely of travel and travel tech to your overall revenues?
We don't separately call that out as an individual sector, but it's part of our overall consumer business.
Are you confident that you will be able to end the year with top quartile revenue growth as you've seen in the past?
I think the aim is to continue the business momentum. Reema, the top quartile, whether we achieve at the end of the year or not, also will depend upon how the overall sector does. But we're confident that the momentum that we've seen in these two quarters, we should be able to carry that in the Q3, Q4 as well.